Thanks to our friends at The Motley Fool for sponsoring this video. Check out the link below, fool.com/the smattering, to get access to the 10 best stocks to buy right now. One that's down more than most is Blackstone. We're going to talk about why that's the case. And even with its yield above 6% right now, its dividend yield above 6%, there's a not so secret reason why investors might not want to count on the dividend that it's paid over the past year being the promise going forward. We're going to talk about that right here on The Smattering. I'm Jason Hall. Tyler Crow's joining me to talk about it. One of the biggest, if not the biggest in the world, massive amount of assets under management, and they are especially known for real estate as one of the major asset classes that they own. I mentioned that yield. It's above 6% at recent prices. And as much as anything, the yield has been pushed so high because the stock price has fallen. I think there's a case for Blackstone and a lot of the alternative asset managers as still being good businesses to own over the long term. We know Blackstone has certainly been that over the long term. But you brought up a concern in a conversation to me about Blackstone that you want to make sure investors are considering going forward.
Yeah, this is a $69 billion fund run by Blackstone. And it's one of the unique ones where they were actually letting individuals in if you met certain income criteria. So a little bit wider net than they would typically garner with their kind of institutional investment vehicles that they build their assets under management. But what just recently happened is there's been a lot of requests for withdrawals from this particular investment. And one thing that has happened recently as a result of that is that the UC Investments, which is the University of California's investment manager for its pensions and things like that for the UC system, they've actually created a strategic venture separate from this B-REIT, where they took out their investment in that and created a unique return environment, basically, which was a little bit of a premium to what kind of Blackstone was more or less promising in its original vehicle, with get some incentives, and it even offered a kind of a back.
In other words, UC was able to get a special deal.
They got a special deal because they spent a lot of money. And this to me was a little bit, look, this isn't like 5-alarm fire things. This is kind of just one of those where you're like, that's not great, right? Because if you're seeing a lot of drawdowns, you're creating kind of these special vehicles for your higher money clients. I think the bigger thing to hear to me, and we're thinking about it in the grand context, if Blackstone is willing to do something like this, they're trying to stem the tide of withdrawals on their B-REIT, on this particular vehicle, which, asset managers like Blackstone, like KKR and the others, they're a little bit of a black box when it comes to AUM, right? We get some quarterly updates, but we're not 100%
AUM meaning assets
under management, excuse me, which is their bread and butter. They get fees on performance and the management of that assets under management. And for us, it's a little bit of a black box. We just kind of trust that what they're marking their managements on assets under management as is what they are. But if we're seeing withdrawals, it may mean that the AUM is not as big as we had thought, and could continue, and we might see some more drawdowns. And if that's the case, you have lower asset management, lower fees, and Blackstone has a variable dividend. So if we were to see some performance withdrawals, there's a very possibility that, as an investor in Blackstone stock of the business itself, we might see a lower dividend from here.
Tyler, this isn't you feeling indignity at a personal level
not at all
about what Blackstone is doing. This is thinking about this business as that 2 and 20 model, right? The fees that they earn on the assets, and then the percentage they earn on excess returns above the benchmarks. We've talked about in other videos. I describe it as almost they had to take this deal. They had to reach this agreement with the University of California system because they probably need that capital, like you said, because if they're getting withdrawal requests and there's a big drawdown and outflow of investor capital, at some point to meet those needs, you're going to have to start selling assets. And this is not an environment where Blackstone wants to have to start selling off assets that are going to be far less valued now than they were a year or two ago, right? So the concern is that it's a deterioration of the quality of its business, and that's how Blackstone shareholders could be affected.
It kind of spirals downward, right? If you start to sell assets to a withdrawal, your AUM goes down, people start withdrawing because your AUM's going down, and it can spiral. And that would be the greatest concern here.